Hello there, in business tonight. Many central banks in Asia have been forced into the market in an effort to arrest their slumping currencies. From the Japanese yen to the Philippine peso, Asian currencies are extending declines, having already tumbled this year as rate hikes by the U.S. Federal Reserve bolster the greenback, and investors have been gripped by fears of a recession. Well, the yen has slumped more than 20% to a 24-year low, while the Korean won has fallen about 17%. Meantime, the Philippine peso and the Taiwan dollar have both dropped some 13%, and various central banks have sprung into action to defend their plunging currencies. Now, Taiwan's central bank sold over $8 billion to intervene in the forex market to try and arrest the Taiwan dollar's devaluation. Taiwan's currency and stock market have tanked in recent weeks. Meantime, South Korea's vice finance minister said that the government will buy back about $1.4 billion of treasury bonds this week to help stabilize the market. Bang Hee-sun also said the government was reviewing more policy measures to help ease volatility in the stock and corporate bond markets if needed. Asian economies have been digging into their forex reserves to support currencies. Nomura estimates that India has spent about $75 billion this year supporting the rupee in the spot and forward markets. China has spent about $37 billion, Thailand $27 billion, and South Korea close to $17 billion. Well, both the Reserve Bank of India and Bank of Thailand have used up more than 10% of their end 2021 headline reserve levels. And while Asia is suffering, Britain may be teetering on the brink of something worse. Now, the Bank of England is the latest to intervene. In fact, it's announced that it will buy as many long-dated government bonds as it needs to calm the market. The BOE's emergency action aims to stem a crisis in the markets caused by the country's Chancellor Kwasi Kwarteng's plans to cut taxes. Well, for more on the BOE's move, Oli Barra joins us from London now. Oli, how have the markets reacted to the BOE's move, and will it be enough to stabilize the markets?
Mixed so far. It does look like in the short term there have been some nerves calmed on stock markets and bond markets. It appears that the yield on UK government bonds has dropped a bit, which will be certainly welcome news at Downing Street, with the government really worrying about its borrowing costs spiking after last week's so-called mini budget. Slightly different case on the currency markets, with the pound down yet again against the US dollar, heading towards, at times, those record lows that we saw earlier in the week. In terms of whether this is going to be enough, that is really the gamble here from the Bank of England. It faces that very difficult balance from wanting to be seen to be doing whatever is necessary to prop up the UK economy, to prop up the currency, to address some of those concerns around cost of UK borrowing. But at the same time, it wants to avoid being seen to be panicking and therefore creating further concerns about the UK economy, which could make the situation worse. Certainly the Bank of England is saying that it will do whatever is necessary. But when it talks about things like a material risk to UK financial stability, the bank really talking in very, very stark terms indeed about the UK economy. And as I say, that's the kind of thing that can lead to further panic in financial markets, which is what the bank is trying to avoid.
Well, Oli, the government is still sticking to its planned tax cuts despite the IMF's criticism. So how is it reacting to the growing international backlash?
So far, it is sticking to its plans. Yes, we've had a statement from the Treasury today saying that it welcomes the move that the Bank of England has been making, saying that it will continue to work closely with the Bank of England, but also insisting it's committed to the Bank of England's independence. The Chancellor Kwasi Kwarteng has also been meeting with bank bosses today and yesterday, and also with Conservative MPs. That is designed to be partly able to reassure international investors and domestic investors in the UK economy about the government's financial plans, those tax-cutting plans that were announced last week. But one real concern for the UK government is that it can say as many times as it likes that it is committed to its economic plans and its tax-cutting agenda. But that tax-cutting agenda, in the short term at least, requires a huge amount of borrowing to fund it. And if borrowing costs continue to spike, then the UK becomes less able to fund those tax-cutting plans. So that's leading to all sorts of speculation that the government might have to, at some point, either U-turn or indeed announce a vast programme of public services cuts, spending cuts, to be able to avoid the tax-cutting plans that it wants to put in place. So all sorts of uncertainty, not just about the UK economy at the moment, but about the UK government's entire economic strategy.
Oh, thanks for that, Ollie Barrett there in London.